Hi there, everyone, and welcome to our December edition of On Track. It's the 20th of December as I speak, and I just want to start by wishing everyone who tunes in a great Christmas and New Year break and holiday, and hopefully you have an awesome time as we roll into 2025 and we live in fascinating times. So we've got all the news and up-to-date stuff for end of November and right up to the minute on the news. What we're going to cover today, all the usual updates on markets, interest rates, property, etc. There's a lot going on, and I'll talk about a few things around that. But firstly, just a warning. This presentation is for clients of McGregor Wealth Management, and particularly those that use the CARE investment methodology. Everyone else welcome to listen, but please get advice before acting on anything we talk about. So let's have a look at the news firstly. So the Fed, just 2 nights ago, cut rates by 25 basis points. That's a quarter of 1%. So down to 4.25. So you'll notice they're finally under our rate. So our cash rate, which has been unchanged for a long time now, is 4.35. So the Fed's now cut 75 basis points. So they've gone from 5 to 4.35. So they started above us. That's part of the reason that the RBA is slower as well. Now there was a reaction. Shares had a great year. They had a rally post the Trump election, but they came back on that Fed cut because the tone of the Fed's narrative, and the market's always looking to see what the Fed say as well as what they do, was that inflation's a little bit stubborn. And you can see here US inflation has gone up again a fraction. So in the last 3 months, it's gone 2.4, 2.6, 2.7. Still under 3, but it's just that little bit stubborn. So that the market has read that is then the next cut may be further away and it may not be cut as much as we think. So the market's starting to come to the conclusion that rate cuts may not go as far as they initially estimated, which in some ways is not surprising because we've gone from super low to even the cash rates in Australia at the moment are 4.35 are not they're not high. They're higher than they were during the emergency period of COVID, but they're not actually high. So we'll see what happens. The RBA is still steady, no talk of increases. Which is a good thing. So they've ruled out increases, so away from that. But the question is, when will the first cut be? And the market's talking potentially in May. On the good news side, really strong profit growth for US shares. It looks like the public listed companies over there are on track for profit increases of 12%. That's rock solid. And a lot of that is coming from that big end of town, the Magnificent Seven, the tech companies who have got profit growth way more than that. We talk a little bit at the moment about a two-speed economy. You've got some companies doing really, really well and some companies not so well. Yeah, in the end, we own most things, so we get the averages, which is okay. We don't miss out. Look, Trump is inaugurated on, I think it's January the 20th. So he's still in that in-between period, but he's talking strong on ending wars. Putin's ready to sit down with them. Israel is certainly starting to talk more open. So, it's quite possible. We'll see whether he delivers, but it's quite possible all of a sudden two major conflicts may ease. That's going to be seen positively across share markets as well. We'll see what happens, but certainly it looks more of a possibility than it has for a long time. Look, the US and Australia is got some of the lowest unemployment numbers we've seen. So while that's good news, it does mean that inflation conversation stays around because obviously when they try and put up interest rates, they're trying to cause unemployment to go up to slow the economy down. And the economy is still going well. So underneath all that is actually some good news, but it is two-speed. The US is much stronger than Australia. The mid-year budget estimates, which came out this week, showed debts and deficits for a decade or more. Both sides of politics have been unwilling or unable to either cut into the fundamental expenditure. In Australia carries a lot of expenditure that it really can't cut. Things like social security, age pension, welfare, etc., NDIS, aged care, hospitals, all the rest of it. We live in a good country. We've got to pay for that, but the major parties have been unwilling to face how they resolve that deficit. You can't leave deficits forever. You can grow your way out sometimes, but ultimately they're going to have to work out how to tackle it tax-wise, but neither party wants to talk about that at all. Speaking of which, we're due for an election that should say May 17th or earlier, 2025. So Albo will decide whether he goes early, whether they'll sit Parliament. If they wait till May 17, they'll have to release a budget. I suspect they'll probably announce before then, so they don't have to release a budget. But I think they were hoping for interest rates to be dropped, and the market consensus, as I said, for the RBA is possibly around May, so they may not get that drop. So we're going to see some interesting politics, and it's certainly much more even than we thought it might be 3 or 4 years ago. So just on the numbers, we talked about the cash rate still stable, 90-day bank bills, still in that 4.4 range, no real change. 10-year bond yields went down a bit, then back up following that US Fed announcement, but they're still in that mid fours, and they seem to be planted there at the moment. The Aussie dollar has weakened, so that's helped. That helps cushion any drop from US shares, and you'll see when I compare Aussie shares and international shares have done better in the last month just because of that drop in the Aussie dollar. Drop in the Aussie dollar gives us a free kick in terms of international shares, and a rise in the Aussie dollar is a handbrake on international shares. Aussie inflation, we won't get this month's number for another week, so that'll be actually, I'm not sure whether they're going to report that before Christmas or after. But we seem to be comfortably inside the zone, but keep in mind it's artificially there because of the government's electricity handouts, which has the effect of shaving money off CPI. So it's kind of smoke and mirrors in some ways. Mortgage rates, no change. There's slight changes around term deposits, but there's no real action in interest rates. So fascinating. So let's have a look at markets, and as you look down the 1-year numbers, and even as you look, so if I start at the bottom here today, listed property up 40%. Now it had a horrid time a few years back, so part of that's recovery numbers. International property 20%, Australian shares 23%, emerging markets 13%, international shares 30%. So it's a stellar year for shares, and that's led to the returns we've seen. You can see care high growth over 1 year, about 22%, core growth 20%, 18%. So when you look over our 10-year numbers, well and truly exceeding, and inflation about 2% over that 10 years. So well and truly exceeding our targets, which we use. For us, always the purpose of your portfolios is to achieve your longer term goals. So we have these targets that allow us to plan. We've kept the investment committee has kept the dial at 10, which means the market's a little bit expensive. If you missed last month, please go back to that, and I talk in there about what that means and some of the strategies, particularly for new money around there. But it's not crazy. And when the market's a little bit expensive, a couple of things can happen. One, if profits keep growing the way they're growing, it will actually justify the markets, and we may bring that back. The other thing is, there may be little corrections here or there that bring it back over time, or there may be bigger corrections. And the market can always get more expensive as well, particularly if profits keep growing. So good numbers across the board at the moment. And as I said, your care portfolios, well and truly above average. They sit closer to the top of the tables over 10 years and most of the periods that they do. And our goal is always above average performance, below average fees. The 20-year chart, where it just emphasizes, the reason I show this all the time is just to emphasize that wall of worry. We just continually go through these valleys of fear that we forget as soon as we're out of them. The most recent one being the valley of the fear of inflation. And you see that pick up this year, where we've said, okay, we've beaten inflation. Well, we're now worried about 3.2% as opposed to 2.5%. But you go back a year, 18 months, and inflation was 9%. So that was a serious worry. But we go back to all these other fears. And the market, you got to remember, the market's natural incline is up because companies grow, economies grow, and that's good for the companies that are in it. So natural gravity in markets is up. But occasionally, we get, not occasionally, but regularly, we get these valleys of fear. Occasionally, we stop worrying and we have the booms followed by the busts, and then back to the wall of worry. We believe we're quite firmly in the wall of worry at the moment. A little bit expensive, but one of the possibilities, when you look at the bookends of possibilities, is that we're at the start of another boom. At the other end, we might get a 10 to 15% correction. They're both reasonably possible outcomes, and in the middle is just that grind up the hill there as well. But you never want to be out of the market, almost ever. You can take other precautions, but I'll talk more about that later. In my exciting life, boring money update this month, because that is our philosophy. And I started this page to talk about the things that we've dodged, because we often talk about the things we're doing, but part of good investments is avoiding big mistakes. And you might be hearing, you might not be, but a lot about private credit. So post the GFC, the banks got they got slap on the wrist. They had to tighten up lending, and it created a bit of a space that's been filled by private credit. What's private credit? It's basically a closed-end managed fund. So a fund manager goes and raises a bucket load of money from investors, often high net worth investors, often industry super funds, often family offices, so often lots of rich people, and they lend that to businesses and property developers, etc. Now, private credit's always been there, always serves a purpose, but it's had a massive expansion, particularly in the last 10 years, to the point where it's now at a stage that is worrying to us. And not to say they're all gonna, all those loans will fail, but we're starting to see what I would call the bodies float to the surface. So a few months ago, we had Australian Super report a $1.1 billion loss. Now that's relatively small in the context of what Australian Super manages, but it's the first indication that this supposedly low risk area is starting to have some cracks. There was a big one yesterday in the Fin Review. So MaxCap, who's a local private credit firm, backed by Apollo Global Management, they lent money to a property developer, APH Holdings. That property developer, which was a Chinese property developer operating in Australia, has failed, and that's going to cost them $150 million. So that, and they had initially told their investors they'd lend them 70 million, and that if the company failed, they'd get back 68, but they're actually going to lose more than that. And it's just capitalized interest. So one of the challenges with private credit is it's not transparent. When banks have to report to the RBA, APRA, etc., on their bad debts on loans in arrears, there's absolutely no statistics coming out of the private credit market. The regulators are watching this, and the regulators are very concerned, and we may see them impose statistics. But this is going to be a case of what I call iceberg risk. So you can't see it. You see these, and private credit are offering returns of 8 to 12%. Now, obviously, when banks will lend to businesses at 7 or 8%, let's call it 6 to 8%, anyone who's borrowing at 8 to 11 is doing it for reasons that they prefer not to be dealing with the banks, or the banks don't want to deal with them. So private credit can be naturally riskier. That can be good if the risk is rewarded and if there's no failures. But as it's insane amounts of money that are now flowing into private credit. And whenever money flows into one area, you tend to get quality suffer because they've got to lend the money. They leave it in the bank, it's getting 4%. That doesn't pay their investors any money. So they're trying to lend it out. And if deal quality, read credit quality, gets compromised, we're going to see more of these failures. I suspect we're going to see a lot more. We've deliberately dodged this over the last 4 years. We've seen it rising. Industry super funds and others have a lot of exposure. They've done well out of it, but they're probably going to have some hiccups as well. And one of the challenges is they don't necessarily mark this to market. I'll give you an example. If a corporate bond is listed and interest rates go up, the value of that bond goes down because interest rates have gone up. With private credit, it's not marked to market. So the investors have no idea really how it's going in a capital value, and they also have almost no idea how it's going on a credit quality. The chances of them not getting some of their money back. So be careful. Always happy to talk about these things, but we're avoiding private credit, private equity. I'll talk more about private equity probably next month, just because of the sheer volumes of money that are gone in, which tends to compromise quality. Bond yields, boring old bond yields. And the reason I talk about bond yields so much is because bond yields they're the biggest market in the world, or one of the biggest markets in the world. So it reflects what people are thinking about about inflation and interest rates. And it's the consensus, of everyone in the market. So we see bond yields, the latest, the dark blue line, they've jumped up again a little bit, literally in the last week off the back of that Fed announcement. So we're starting to see, sticky, and you can see on the bottom charts, both in Australia We're bouncing around between 5 and 4%. We're right in the middle of that at the moment, 4.5%. And keep in mind, higher bond yields is bad for the share market because it probably means higher interest rates, but also higher inflation. Lower bond yields are better for the share market. Steady is good. If we bounce around in a range of 4 to 5% long term, that won't surprise. But the market had been sort of expecting bond yields to drop back to maybe 3.5%, 4%, but it seems to be stubbornly in that area now. And that's okay. I actually don't mind this. It means for fixed income investments, it means for balanced investors, you're getting a decent yield on your bond element. With cash at 4 to 5 and bond yields at 4 to 5, that's okay for defensive investments. And this is the challenge, though. Some people still think that's low, so they go chasing things like private credit, where they might get offered 8 to 11%. But private credit is not a defensive asset. You're lending to a business, so it's without mark to market, without regular credit checks. To me, it's an aggressive investment like a share market investment, and it gets share market like returns, 8 to 11%. But guess what? That means it's got share market type risks. True defensive assets are money in the bank bills, government bonds that are truly defensive assets. Anything that chases higher returns obviously has a higher risk, but the world's playing some games at the moment. So we're seeing so-called defensive assets get a lot more aggressive, and we'll probably see some carnage out of that over the next few years. Hopefully not too bad. Yeah, all of that's talking about our model, the wall of worry, boom bust wall of worry, as it plays out over history. We still believe we're very much in the wall of worry. A little bit expensive, but certainly not into the crazy boom territory. But we're very mindful of that. We spend a lot of time talking about where we're at relative to history, because we're always on the watch of a possibility of the big downturns. And this chart, which I've got in all the time, just shows to remind us the 9 biggest downturns since 1900, literally, so 125 years, with the smallest one of the 9 being 21% and the largest being just over 50%. There's 3 kind of in the 50% category. Now, I always point out, obviously, that the most obvious thing here is they always recover. And what we can't see here is they were always preceded by a boom, except for COVID. And that's just the nature of it. In terms of the mess it up highlight this month, it's just the media. Media's troublemakers when it comes to markets. They love to scare us. They love to keep our attention. It's the worst place to get your investment advice. It was the reason we started OnTrack, so we could provide rational long-term context for the news that's coming out, and not everything's the end of the world as the media. There's some commentary at the moment that we're in the mother of all bubbles. Trust me, this market is nowhere near what I would call bubble territory. Expensive is expensive, that is what it is, but nowhere near bubble territory. And I might do something on that in the next few months to show some of the history of true bubbles, and how crazy they actually get. Yeah, Bitcoin's a good one to look at. It's a true bubble market at the moment. At some point, it will deflate because all bubbles deflate. It's a speculative frenzy. We don't consider it because we're not speculators, and as Bitcoin doesn't produce any income as such, we don't classify it as an investment. It's a story for another day. I will tell people if they want to play with Bitcoin, play with money you can afford to lose. It's a bit like your gambling budget. I do know some people that are very expert in it, but they're very good at trading and ducking and weaving. And my experience, 40 years in markets, I've seen almost, it's such a fraction of a percentage of people that can do that stuff well. Everyone gets a free kick when they're in a market that's going straight up, but it's those that can avoid the crazy losses, which will eventually come. But yeah, watch the media. In our behavioral biases, this one I've got chasing past performance. We still get this all the time. I occasionally get clients ring up and say, hey, my friend was in this fund and it got a higher return. Should I change to that one? And the answer is always no. Chasing the rear vision mirror is the worst way to invest. It leads you to crash. And this chart shows it in asset classes. So all these different colors are asset class. So you can see some light blue where my cursor is, US large cap stocks. You can see US small cap stocks, emerging markets. And this shows the order of returns in markets over time. Back to 2009, it's a US perspective. So it's a US chart, it's financial year. And you can see there's no pattern, no rhyme. There's a few trends. Stocks tend to be at the top of the top part of the ladder more than cash, for instance. But sometimes cash was the top returner in 2022, even though it was negative. Everything was negative in 22, including cash, which is crazy. And yeah, so the moral of the story is here. Don't try and pick don't try and jump on last year's winners just because you think it's going to persist forever. Lazy salespeople of investment houses often jump on these bandwagons to sell last year's performance because it's easy. But the other side of the message here is beautiful, boring diversification, which means own bits of all of this gives us long-term consistent returns. As I said, and I've highlighted this as one of our key pillars today, which is beautiful, boring diversification. And just my definition, which I borrowed from one of my gurus called Nick Murray in the States, I've followed for 25 years. His definition of diversification was just that diversification is where you trade away the right to make a killing in return for never being killed. It's another way of saying don't put all your eggs in one basket. But if you're truly diversified, you'll never suffer dramatic losses that the people that focus on one asset class like Bitcoin or anything else can suffer when things turn around. Let's go through the asset classes, Aussie shares. You can see the chart here. Tremendous run through November. So November was almost straight up. The Aussie share market's pulled back in December. So it's come back. It's healthy that it's pulled back. It got a bit carried away, even though the US jumped up. There's a lot of good stuff going on in the US with tech, AI, profit growth, etc. Australia's running a bit weaker. So I think we joined the post-Trump party and then realized, oh, maybe we're not going quite that good. Markets came back. That's healthy. Still a solid year, 23% year, and still consistent over time. And just, what 10 years looks like when you're getting 8, 9% is growing $10,000 to $25,000, which is, absolutely the sort of stuff we're trying to get out of share markets and consistent. US shares spectacular, 36% year. You can see that at the end of November, it had gone up and it's continued to go on up. Part of this is because the Aussie dollar has dropped. So for us Aussies, that boosts US share market return. So even though US shares have actually been flat and come off, we haven't hurt as much from that because the Aussie dollar's moved from about 65 to 62 cents. So the Aussie dollar is a buffer for us investing overseas because quite often when markets go down overseas, the Aussie dollar often goes down as well, which shelters those. So it's a nice buffer. Occasionally, when the Aussie dollar gets low, we will hedge, which means we'll lock in low exchange rates so that when markets go up, we actually enjoy the full benefit of that rather than get handbraked by the currency because it's the other way around. So US shares solid, global leaders, which is kind of the same stocks at the moment, the Magnificent Seven, etc. A stellar year, 32% as well. And you can see the tremendous growth here over 10 years. Yeah, $10,000 growing to 44,000. And that's what happens when you compound at 14%. Now, for us Aussies, 4% of that return comes from the Aussie dollar dropping over the last 10 years. So even though 14% sounds huge, the US market itself is closer to about 10, 11, 12, depending on exactly which index we look at. But you can see that one went up in December as well. So quite the contrast. This is why diversification is so important. While Aussie shares pulled back, our US shares have gone up in December as well for now, helped by the Aussie dollar falling. US small caps, another stellar year, massive catch up in July, and then another massive catch up in November. Quite stagnant apart from that, except for those two big jumps. And it's pulled back a little bit in December as well. And this is the broad masses in the state. So it's names you've never heard of, but it's the bread and butter of what we would consider large caps in Australia, but small caps in the US. And spectacular returns. We always expect small caps to return stronger than large caps over the long run, but they do so at different times, which makes them perfect to pair in portfolios for the diversification benefit. Emerging markets has been the problem child for the last 10 years with an average of 5%. A better year last year, but you can see when Trump got elected, the November number was down 3%, partly off the back of fears of tariffs, particularly against China, which still forms part of emerging markets. Ironically, emerging markets have recovered in December. And we still believe emerging markets will outperform in the long run. They're more volatile, but that just once again adds to the diversification benefit over time. Gold, another stellar year, 32%. And gold is perfect during times of volatility. It's perfect as a hedge against inflation, and the diversification benefit as well. So that sits in the active portfolio and has contributed to good results. Let's talk property market, and property market definitely slowing down. We have our overall model of boom bust boring, and that long periods of not much, followed by increases, followed by slight decreases, and long periods of not much before an increase. We've certainly had a good time. I found a good article that I resonated with, and I've been talking to colleagues. One of our investment committee members is a senior academic in Australia. So we've had lots of conversations about the knee-jerk reaction of politicians dropping the amount of students coming in to respond to media criticism that it was exasperating the housing crisis. So this article by Karen Delos, who's a property analyst, sort of refutes that, and I kind of agree. We've got a massive rental shortage for all sorts of reasons. Part of it was population growth, but when she looked at the numbers that are actually the case for what students take up, these are small numbers. So across each state, which is down the bottom here, so those numbers are much smaller than it seems. So they range from 2% on the right to 4% to 6%. In Victoria, about 7% of the market share. But ironically, they're concentrated in inner cities and around universities. And there's purpose-built. Have you ever seen student accommodation? They're small, affordable units built around universities for the most part. There's 73 postcodes. Sorry, 73% of postcodes in Australia have less than 1%. Student housing. So it's just not an issue. The real issues around the housing crisis, as Karen points out here, years and decades of not releasing enough land to keep up with the demand, restrictive planning laws from local governments to state governments, and not planning ahead to incentivize affordable housing. The tax system, they keep land tax in Victoria, that's slowed down investment. They've increased land tax down there. Governments are not tackling long-term issues. And the craziness of this one of stopping international students is it's one of our top 5 exports, education. So when people come into Australia to learn, they bring money into the country. So we're losing that from our growth. And Australia has very tepid growth at the moment. And this has certainly contributed. So I just thought that was interesting. And it highlights the problem we've got in politics, and this comes from both sides. And Dutton was quite aggressive in criticising the government for allowing too many people in around this, and Albo folded and just responded because it was the easy, popular thing to do instead of having a nuanced debate. So failures on both sides of politics here to actually address the real issues, which is how do you streamline planning to get things coming out. And I don't think the crisis is going to end anytime soon because it's very slow there. Potentially, enough development will come in, but it's a decade-long thing. It's not going to. You can't build millions of properties in a year. It takes a while, so that's not going to go away. In terms of the wrap to 30th of November by capital city, when we look at houses in the middle, we can see as we go down, Sydney up 3.5% for the year, Melbourne down 2.3%, partly driven by the land tax. Our property gurus that we talk to suspect that once that's cleaned out, Melbourne is quite undervalued at the moment. So it's been down for longer. The median price of a Melbourne property is below Brisbane, Perth, and Adelaide at the moment, which historically is not the norm. So I suspect that'll catch up somewhere in the next period of time. But at the moment, that market's been held back by that land tax across all investment properties there. Brisbane, a solid year at 10.5%, Adelaide 13%, Perth 20%. But it is slowing down. The momentum is slower across the board. The experts, and keep in mind what we've talked about on expert forecasts, are not forecasting a big return next year, but experts have an almost perfect track record of being wrong. So we'll see where that goes. But it certainly seems like property's had a good run. But keep in mind, there's more than one property market in Australia. As I said, we may see Melbourne recover. So there may be opportunities there, particularly Melbourne units, which are a long way behind the long-term growth rates. And there's always pockets of good investments for those looking for long-term wealth creation. Absolutely no change in the mortgage markets, like zero change. These numbers are exactly the same as last month. And because we're going early because of Christmas today, I haven't got the latest update from Performance Property as yet. It'll probably come out. Yeah, well, we'll have it for next month for sure, but no real change. And you can see, as I was talking about, everywhere in Australia is at a different spot in the performance cycle. You can see Melbourne heading in that stagnation, but at some point the next step is value to buy. Same as regional Victoria. Sydney's been a bit stagnant as well, and so some of those will start to appear in the buy value over the next little while. You can never tell exactly when, so there's always somewhere to invest. And places like where I am at the moment, sitting on the Sunshine Coast, has had a tremendous run, but it's probably in the top end. And it's not to say it can't have another run. Sunshine Coast was re-rated just with the sheer amount of money being moved to the coast into property, which looks like a permanent home. So let me wrap up and once again wish you all a Merry Christmas. But yeah, as always, exciting life, boring money is our motto. And yeah, the principles that behind our process are just that all investing is best done as part of a real plan that has goals that are based on your life. Portfolio is designed to meet those goals. We take a long-term view. We do all the boring stuff: diversification, asset allocation, make sure you've got enough liquidity to get through crisis. That's led our clients to have well above average results and through all sorts of crisis. We get access to the growth markets for mostly through low-cost index funds. There's times where we avoid an index in a certain area for specific reasons, like we did with bonds. But for most of the times, we want that cheap access to markets without trying to pick the winners and the losers. Protecting our short-term volatility through the reserves that we hold for our retired clients and through dollar cost averaging for our wealth accumulators. And beautiful, boring rebalancing makes us money every month when we restructure at the margin the portfolios, selling, taking a few little profits and topping up other things. There is only three ways to lose money when investing on the share market in particular, and that's panic and sell when the market's down. It's having to sell when the market's down, and it's not being properly diversified. Congratulations, we've had no one do any of those things this year again, and partly because of the ongoing conversations we have. I just want to thank you as always. We appreciate your listening to these things, but more importantly, we appreciate you trusting us on your financial journey. And I just want to wish everyone an awesome Christmas, Happy New Year, and yeah, let's hope it's a exciting life 2025. We'll see what happens on the money. There's certainly lots going on. Happy New Year. Talk to you all next year.